Hey, everybody out there. With us again is Mark Collingsworth of Vere Global Wealth Management, and he's here to talk about today's latest report on the state of the U.S. economy. Now, technically, it's known as a CPI, that is the Consumer Price Index, but it is loaded with some useful information that's being spun in various ways, depending on the political party that's spinning it. So, Mark, overall, was this good news or bad news? What are the essentials of it?
Well, I guess the easiest way to describe it, it was really bad news because the Dow Jones Industrial Average dropped over 1,200 points.
That's quite a drop. We haven't seen that for quite a while, right?
Correct. You have to go back to May or April of this year to see anything even close to that. So that was almost a 4% drop in the stock market.
And that was because it was a reaction to what?
Well, because the CPI numbers, and here's kind of the rub, the Federal Reserve has been raising interest rates all year long, right? Well,
Right.
you'd expect with raising interest rates, inflation should start coming down, especially since gasoline prices have been coming down as well. But guess what? Inflation now is starting to go back up.
So what were the actual numbers today as compared to last month?
The expected number, the number was forecasted to come in at 8%. It actually came in at 8.3%, with the biggest contributor not being gasoline prices, but the main contributor here was actually food prices, which actually went up over 13% as a whole.
And actually, there's also a core inflation number of 6.2, I believe it is. And that in itself, which excludes food and gas, that is quite high when you exclude those two items.
That's correct. And what that basically tells you is now inflation is now actually starting to spread through the entire system, and other things are starting to go up. So the price of socks are going up, the price of paper, sunglasses, all those things are going up along with oil and housing.
So this isn't transitory, this isn't temporary, as we've been hearing.
No, I would say it's definitely not transitory.
All right, so there's been debate over whether or not we're already in a recession for the past month or so. And of course, the Biden administration says no, that's not the traditional definition of recession. What is it, two quarters in a row?
When I was in college, the textbook definition is two back-to-back quarters of negative GDP is an official textbook definition of recession.
Well, we can't go by these past archaic, outmoded
And,
definitions now, can we?
well, no, and you can't go against Bill Clinton, who used that exact same formula, or Barack Obama, who used that exact same formula to describe a recession when the Republicans were in office.
Okay, now, getting back to today's numbers. So actually, there was an increase over last month, but overall, what direction are we moving in? Are we beginning to pull out of it? Are we beginning to see daylight? Or do these numbers indicate that we're not improved at all and maybe starting a downcline again? What do you think?
Well, there are two thoughts here. One, inventories at a lot of your firms are starting to bloat. They're just going. If you look at the company, Electrolux, which is actually owns Frigidaire, they make refrigerators, ovens, things like that. Their sales have actually started to plummet, but their inventory is going up. So they bought all this inventory, but no one's buying it. You've seen the same thing happen at Target, Walmart. All these stores are having inventory bloat. The prices are so high, no one's buying them. I believe once we get into closer to Christmas, you'll see these companies starting to cut prices. But here's the real rub in the sand's going to come, and a lot of people are ignoring this. Come Friday at midnight, we could be facing the largest railroad strike in U.S. history. And if that railroad strike goes into effect, 42% of your railroad system will stop running.
And consequences?
And supply chains, if you thought you had problems getting products on the shelves now, think what's going to happen when 42% of the railroad system stops running. You thought supply chains were bad back here during COVID. That a railroad strike will be 10 times worse.
And correspondingly, because there would be even more scarcity, prices would climb even higher, correct?
That's correct.
Now, supposedly the Biden administration is playing referee between the railroad unions and the companies. How do you think that's going to turn out?
I think that's very laughable, and I'll tell you why. Because, okay, so under the Railroad Act of 1922, 23 or something, the president, if there's a strike, he has the ability to delay it by 30 days. 30 days comes to an end on Friday. And during that 30 days, he gets to appoint a commission to actually help the strikers come to a solution. Here's the real rub. You've always heard about Joe Biden, how he's so great on unions. Unions are so great, and the Democrats have always loved unions. Guess what? They went into the meeting and they told the workers who were striking to get better working conditions and higher wages, they told them, you're asking for too much and you need to get back to work.
Who told them that?
The Democratic committee that Joe Biden sent to help the strikers.
Well, that's kind of going against their base, isn't it?
It is. But the thing is, they don't want to strike, because if inflation was a problem now going into the midterms, a railroad strike will be a death kill for them.
And, with that 30-day period, a lot could be destroyed in those 30 days before it is resolved.
Well, the 30 days comes to an end Friday of this week.
Oh, even worse then.
Yeah.
All right. Now, also adding to this, looming over all of this is the threat of another steep interest rate hike by the feds. Now, how soon would that come?
That's going to probably come next week on the 21st, which is also the fall equinox. The market was forecasting to probably do 75 basis points. If you look at a trading tool called the Fed Funds Futures, those, as of this morning, they were predicting now 100% chance of a 75 basis point increase. And the Fed Funds Futures are now, people are starting to place a bet with those financial tools, 47% probability it will actually be 100 basis points, or a full 1 percentage point.
Wow. I mean, that would really be a kick there, kick in the rear end.
Correct. You haven't seen 100 basis points since 1984.
Now, if that happens, again, what's the result?
Well, it won't do anything, because as long as inflation is higher than the interest rate, or higher than the Fed funds rate, you could raise the Fed funds rate 200 basis points and it still won't have an effect, because the inflation right now is the true real rate of return on investments.
But the effect it would have is, and fairly quickly, is mortgage rates go up, credit card rates, loans. So that's going to really be another kick to the consumer, correct?
Correct. And that's one of the things a lot of people don't understand is the Federal Reserve has no real power over controlling prices. They have no power over controlling supply. They really don't even have any control over demand. But when they do say we want to reduce demand, which is their key pivot word, because they really can't control demand, but they say we want to reduce demand, what they're really saying, and this is Fed speak, is when they say we want to reduce demand, we're saying we want to raise interest rates to make your credit cards cause the housing market to drop, so that you lose your job, so you don't have any money to go and buy a new car, no money to go buy a new house, no money to go expensive food. That's what their real goal is they want people to lose their jobs.
Because when that happens, mass loss of jobs, then the prices go down, inflation goes down, because nobody could buy anything, right?
That's exactly correct.
So, is the cure worse than the disease there?
Based on Federal Reserve history, the cure is much, much worse.
Wow. So, I mean, we're heading into we're continuing in troubled waters, which seems to be churning even more troubling at this point. Now, also, I'm curious about gas prices going down somewhat. Will that last, or will they go up again? And what's bringing them down right now? And what are the consequences of that?
Well, funny that you should ask that, Larry. The reason why they're going down is we have a thing called the Strategic Petroleum Reserve,
Right.
which is an emergency oil supply for the U.S. military to use if we go to war. Joe Biden has been hitting that thing hot and heavy. He has cut the thing almost in half so far this year, over 400 million barrels. And just this week alone, they're going to drop 8 million barrels of oil on the open market to push prices down even more. And it's kind of stupid also, because today they came out and said, because at some point you have to buy the oil back, right? Joe Biden came out today and said, we're going to try to start buying it back at a discount at $80 a barrel. Oh, great. Now, as a trader, I know that there's someone's going to have to buy 400 million barrels of oil at $80, and they have to buy it back. You need to start buying oil, Larry, because it's not going to go down now.
Good investment there. Now, also, a more serious concern here is we're depleting the strategic petroleum reserve, which is for emergencies such as wartime. Now, what happens if there's a real emergency or if we go to war?
Well, if we were go to like a full blown out war, and I'm talking like a World War II event or even a Vietnam top level war, I'd be very surprised if the Strategic Petroleum Reserve would be able to hold out for more than 6 months.
How soon could Biden replenish the supply?
Well, he could replenish it instantly, but he doesn't want to because he's trying to artificially push down the price of gasoline between now and the midterms.
But how would he replenish it? Where would he get the supply?
I bet he'd have to buy it from China,
which is actually Russian oil, correct?
Which is Russian oil. Yes, the China, you can't buy Russian oil, but the Russians are selling to China, and China's slapping their name on it and selling it to everybody else.
And of course, as you say, it's going to be bought. If he's able to replenish the supply in the strategic reserve, it's going to be for top dollar, right? I mean, the price is going to go up.
Correct, because by him coming out and saying, I mean, you don't tell somebody what you're going to do. Now all the traders and all the hedge funds know where he wants to buy 400 million barrels at. They're going to start buying more of it because he has now set a floor on it. It just doesn't make any sense, Larry.
Yeah, another question is what is the final outcome, of this whole trend that we've been experiencing with the economy, with supplies, with the feds? I mean, there doesn't seem to be right now any glimmering of light at the tunnel. I mean, well, first of all, the Dow plunged almost 1,300 points today. Mm-hmm. Tomorrow morning, when the stocks open and when it closes tomorrow, are stocks going to start returning to normal, or is it going to be another rocky day?
Well, that's kind of the mystery here, because the Federal Reserve is now in its blackout period. None of the Fed governors can make any comments about the CPI or any economic data until after the 21st. So between now and the 21st, everybody's going to be sitting on pins and needles. And from my experience, it's just a whole lot easier to sell and then fix the problem afterwards.
All this oil that we're buying, and some that we're still producing here, is that reserved for domestic consumption, or does it go out on the world market?
It's supposed to be just for domestic, but what happens is they sell the oil to somebody like Exxon or Chevron, and then they have a contract with China, and if they don't have the oil themselves to meet the contract with China, they turn around and sell the oil they bought from the SPR. They sell that to China.
So oil from the strategic reserve is going to China, some of it anyway.
In either directly or indirectly, it's finding its way into China.
Mark, is there any sanity to any of this policy?
Well, what it really comes down to, Larry, is politicians no longer try to do what's in the best interest of the country. They try to do what's in the best interest of keeping their political party in power, and they don't care what kind of sacrifices American workers have to make through inflation. A lot of this came, the spending. Democrats went on a spending spree trying to basically indirectly buy votes. Perfect example here. Joe Biden was down quite a bit in the polls, but down quite a bit in the polls amongst independents, more specifically millennials who were independents. But the second he did that student loan forgiveness thing, his popularity amongst those independent millennials has skyrocketed in the last 2 weeks. And let's not forget, because he has now basically spent by forgiving $500 billion worth of loans, he essentially has spent $500 billion, which technically under Keynesian theory of economics, inflation should go up even more from that.
Yeah, I mean, he's making a series of moves that he considers a way to buy votes. And again, as you say, it's for political gain rather than for the greater good of the entire country.
Yeah, totally agree with that.
Well, okay. Again, not very good news. but we have some expert analysis once again from Mark Collingsworth of Vere Global Wealth Management. Mark, stay tuned because I'm sure there's more rough waters ahead that you'll help us navigate in terms of your expert analysis on this. Mark Collingsworth of Vere Global Wealth Management, thanks for being with us once again.
Glad to be here.